Hi guys, welcome back. So after watching my last video to address the current risk behind investing in Chinese stocks, you're probably wondering, why should I still invest in Chinese stocks while I can have so many other better options, safer, with good return on investment in the US stock exchange for US stocks? And my answer is because I want to look for more return on investment. With my past experience, it's just the reward usually goes with the risk. The more uncertainties, the more potential upside there will be. But of course, sometimes it will be the opposite if you get really unlucky. But that is my investment style, is to find bigger opportunity lying beneath the risk or uncertainties. In my past investment experience, I usually find that the more certainty a company had gotten into, the less or lower return on investment. Usually, but of course for investors with less risk tolerance, it would be good to just buy and hold stable stocks like the FANG or ETF. And it really doesn't feel good to buy into the stocks and it keeps going down while you see the others keep going up. It's a very difficult situation to be in and very hard feeling to fight. Just when you see the Hang Seng Index making the yearly low every day while the Nasdaq and S&P 500 is climbing up, making all-time high every day. It's very hard to tolerate. I had shared with you an experience in the past that I sold Fastly, ticker symbol FSLY, when it was here around 80, and right after I sold, it just kept going up and grew 20% to be around 100. And especially I sold Fastly to buy a Chinese stock, one of my top 5 lock-in. So I sold Fastly to buy into lock-in, and then right after I bought, it just kept going down and dropped 20% instead. So I sold something that had gone up 20% after and bought into something that decreased 20% after. That's up and down at least 40%. It's hard not to do the comparison, especially during that time it was looking quite fearful, dropping from $4 to 3.6. It's very hard not to question your decision, and you start to have feelings like every day comparing the two, comparing the choices, and ask yourself the questions. What if you didn't do this? Why did you do this? Why didn't you do this? By just every day comparing the performance between the two. And very hard to fight the urge against changing it back, because look at that, the other stock rising all the time and mine is just doing nothing but dropping. Should I change it back? So it's very hard to fight against the urge to switch again and doubt your decision. But in the end, instead of switching, I have decided to continue buying the dip at that time almost every day or every few days. So in the end, if I had stick with Fastly and did not sell out my position at 80, I would be down around 30% versus to be up 260% for lock-in, because I decided to be patient and stick with it and not affected by the short-term price movement or keep comparing the two, and also to not give up on an investment when it's lack of certainties or driven by fear. Because back then with lock-in coffee, it was full of uncertainties, a lot of fear going on. The company did not give out any news. Many people were losing hope. Just like right now when we look at the Hang Seng Index or some of the Chinese stocks, the big tech stocks especially. I'm sure for those of you who have been holding Chinese stocks for a while, you must be not feeling so great right now when you're looking at the US stocks in the same sector growing on fire. For example, I saw comments telling me that he had bought into Baba instead of Apple, while Baba just declined almost 10% in a few months and Apple had grown 10% instead. So this doesn't feel great at all. Very hard not to look at them, compare them, or lose hope. It feels much better, to be honest, when everything falls together versus when there are stocks flying every day into the sky, making new high, and your stocks are lying down on the floor, going down to the basement, and you are completely losing hope. And my suggestion is that you need to make up your mind to decide what kind of investor you want to be, and as long as you have decided, just stick with it instead of keep changing it. For example, if you want to be a safe investor, then you should invest in the FANG and the S&P 500 and just buy in regularly than not look at them ever. I'm sure you can get stable return on investment in the long term. But if you have decided you are more a risk taker because you want to look for more upside with more uncertainties, then you need to suffer when the other stocks are stably growing every day while your stocks are slowly decreasing. So you need to make up your mind. But the worst thing you can do is to keep changing back and forth whenever you see the other rising, because this would be the easiest to lose money by becoming a bag holder for a while. So my advice is you need to make a decision and stick with it and be persistent on your decisions so then you are not affected by the market price movement, the sentiments, the manipulation. Because yes, Apple is a great company. I'm a huge Apple fan. Steve Jobs is my godfather, my strongest belief and conviction. But I did not invest in Apple, at least not in this year. I sold out of my position last year because I don't see Apple getting double anytime soon. Right now, Apple is $2.4 trillion. So getting double would mean $5 trillion. But I do see Alibaba getting double. Even if it's not double, at least a 50% gain, at least in a medium term. So yes, Baba is dropping every day while Apple is growing every day. But it doesn't mean it's going to continue like this in the future. Most investors invest in the past, not in the future. They base their decision on how much a stock had grown in the past instead of how much a stock would grow in the future. With that said, I want to share my bold thesis on the Chinese and Hong Kong stock market in this video, and also share my thoughts into a stock that had, in my opinion, a massive potential in the years to come if my bullish thesis on the Chinese stock market come true. First of all, the Hang Seng Index, I think it's very near the bottom already. Give it a few more trading days, I think we can know more. But like I said on Thursday, we are on this yellow trend line right now, looking like it's false breaking this support, but this yellow line had been the support for over 20 years. Except for some global financial crisis on the stock market. So every time it touched or dipped below this trend line, it turned out to be the best buy-in opportunity. It's already good when it touched this trend line, but it's extra good deal when it goes below. The only thing is that we don't know how long it would take to recover or to climb back up above the support. But what we're losing is only time. Like I said, Tencent had never been so cheap in history ever, with the lowest PE ratio. Companies like Tencent, Baba, Baidu have very limited room to drop, but much more room to grow. Sure, it might drop another 5 to 10% more. Like Baba, it can drop to 190 at most. So if we buy now, we lose maybe in a long term, we make profit, but 5% less profit. And I think it's not a big deal when it's stretched to a long term. So sure, in a short term, there is still possibility of more bad news to come, no downside, but I think in a long term, we would be okay. And the Hang Seng Index had not made an all-time high for a few years. So now we're near the high of 2007 before the global financial crisis. If we happen to break out this time, we are looking at much more upside. So I think it's only a matter of time, potentially in the medium term. Just the lower it gets, the more bargain it is. Yes, on the Thursday video, I said I drew the golden section from the lowest after the crash in COVID to the highest in February. And I said the whole time we were staying above the correction of 31.2% to be above 27,300. So the whole time it was just a healthy correction for a few months after this run up for near a year. And at most it could correct to 50%, so 26,200. And on Friday, we saw that it had dropped to the lowest of 26,800, so pretty close to the 50% and already in the 26,000 territory. And it closed at exactly 27,300, almost exactly at the 31.2%. So I think give it a few more days. We should be able to see whether it had a bottom, whether this is a golden dip. And I think we should be at least back to 30,000 within this year of 2021. which gives it 15% of growing from this point, at least. And now, let's look at the Shanghai Composite Index. It had been going on the sideways mostly, not making all-time high for at least 6 years. And far away from it actually. People said the Chinese stock market would never rise, never break out like the US stocks. And I think there was reasons behind this. Before, the government never really put a lot of efforts into growing the stock market. Not a lot of unicorn companies listed in the Shanghai Stock Exchange. And also the system behind it's not like the US, which a lot of the retirement pension plan were invested into the US stock. So it cannot fall. Basically, every time there's a crisis, the government would interfere and help the stock market to recover, because otherwise it would affect many people, many parties. The leaders would get blamed and lose the vote, and they will get hurt themselves because their pension plan are also invested in the stock market. But China is not like this. So that's why people say the Chinese stock market would never grow, because it's not the same design and they focus much more into the real estate market. And I think it's true for many years, but this will change. So that is why I am very bullish into the Chinese stock market and think we will have a long-term bull run for the years to come. It is true they focus much more effort into the real estate market before, but right now they're actually doing the opposite, cracking down the real estate market and encouraging the stock market investment. We have went over this last video when I talked about a potential 10-year bull run. And why is that? There was the total saving of Chinese people for 100 trillion RMB, so around 15 trillion US dollar, and they want more part of that saving invested into the financial market. And when the government encouraged that, they would have policies favoring it. Earlier this year, we see China pension funds invested in Hong Kong equities. This is the first batch of Chinese pension funds allowed to invest in Hong Kong equities. This article from last year says the central bank were in talks to increase the percentage of the pension plan invested into stock market to try to reach the average level of the world, because at that time it was significantly lower percentage wise. I saw that earlier this year in 2021 was increasing something from 30% to 40%, so it would mean more money to put into the stock market and also more tied between the pension plan and the stock market performance. So that's a good news for the stocks in general. And then this year there was also a big increase in terms of the numbers of funds. The asset management mutual funds, the number of them had increased quite rapidly from 6,000 in the previous years to 7,000 plus funds, increasing 17%. And the amount of the asset had increased 21%. So it shows the Chinese government, the central bank, really are determined to grow the Chinese stock market. Now, a lot of the bear had been saying that the Chinese stock market would never grow because people don't trust Chinese stocks, they don't trust Chinese companies, especially with what's happening about the whole Didi and the mega caps crackdown, etc. So many bad news, so much drama. People are gonna stay away from Chinese stocks completely and not touch it for a while. So they would never grow the international stock market like they want to, like the vision, and so on and so on. But I think this is the last thing I would be concerned about. It's the market sentiment. People have very, very short memory in the market, and you will be surprised how fast the market sentiments can change entirely based on the short-term price movement. And I mean short-term as a few days or weeks. As long as you see the stock price running up, chances are people are gonna change from bearish to bullish quite fast. Give it a few green bars. There's something funny though, is that back in 2015, the presidency had said something like this casually, just casually, to a reporter at that time. During a visit, he said Chinese stock market would go into 10,000 pretty soon, something like 10 years. So this 10,000 had been somewhat a goal for him, I think. At least I can see that all the way back then, 6 years ago, he had this target. Even though he said it casually to someone, he's still a president, so I don't think it's just a joke. And what if it becomes true? Because right now the Shanghai Composite is 3,500. So getting into 10 100,000. It's almost triple. And within 10 years, it would be 4 years from here because we are 6 years from when he said that. Given it possibly at least 30 to 35% return every year, compound return. And that would be unbelievable. Yet somehow something to look forward to. Because from whatever I'm seeing, is that the government is trying very hard to grow the Chinese stock market, like putting more money, injecting more fund, tying the pension fund into stock market, increasing the asset funds, reforming the system behind the stock exchange, and trying to get more famous Chinese companies, some unicorn, to get back to have the listing in China or Hong Kong. A few days ago, we see the news, China pivots on central bank easing as Fed heads for taper. So while the whole world is expecting the Fed to start to taper, China is doing the opposite by cutting the reserve requirements ratio by 50 basis points. If you're not familiar with this concept, you just need to know that it means it is reducing the difficulty for business to get loans. It is estimated to free up around 1 trillion yuan, so $154 billion injected in the market to boost the economy and might benefit small to medium business more. The point of this is to help more business to recover and the growth to spread more out to different sectors because the inflation had increased the price of commodity, lowering the margin for businesses. So while the Fed is reducing the quantitative easing, at least they have a lot of pressure to do so. On the other side, Chinese government is doing more. And I think the reason is because they were not doing as much QE for the crisis of COVID because China recovered better than most of the economy. So that's why right now they still have room to give out more help to boost the economy. They can still have more room to cut for the reserve requirements, and they might actually reduce interest rates, and that would be much better news for the stock market. But anyways, this news already had helped the Chinese and Hong Kong market recover quite a bit on Friday. Here, the world's biggest asset management company, BlackRock, says the US stocks would be cooled down in the near term due to the higher tax. It would make it more challenging for stocks to keep climbing. So he sees more opportunities in the non-US equity markets, like Europe and Japan, for example. And last month, we see that BlackRock get regulatory not to launch China Fund Company. They finally won approval from China's regulators to launch a wholly owned mutual fund business in China and became the first foreign money manager to be granted a license to run a 100% owned fund management company on the mainland since Beijing opened the door for that option in 2020. So it seems like BlackRock is also bullish on the Chinese market to launch a fund within China. But at the same time, you need to know that they are not so bullish on the big tech company because they think the crackdown on the big tech would last for a while, and a while they mean for a couple years. So they do favor medium to smaller caps in the medium term. This might be longer than I expected, but who knows, maybe they have the information that I don't have. So everything is pointing towards this bull thesis that the Shanghai composite is heading towards a rally, a big bull market for the future years, and I don't know when it would start to have the real strong breakout. It could take months, but if I have to take a guess, I would think it would be the time when the US stock market is cooling off, so the growth has slowed down and possibly in correction. Because I think if I am the Chinese government, that's what I would do. If the Chinese stock market rises when the US stock market rises, feels like the credits it's to the US side because they influence the whole world's financial market. But if the US stock index does in fact get into a little bit cool off or consolidation, meanwhile the Chinese stocks can have the rise, then it would be different and can attract more attention from international investors. So in this case, this is what I see massive potential in this stocks, and it's in the brokerage sector, the Chinese broker So 2 stocks including FUTU, ticker symbol FUTU, and what I mentioned multiple times, TIGR, ticker symbol TIGR. Because they would be a way for international investors to invest in Chinese companies not listed in the US stock exchange. When the Shanghai or Hong Kong index have the real breakout and the big rally, I can see the new users for TIGR and FUTU increasing like an explosion when that happens. So here is the big opportunity I see. In the Chinese brokers sector, specifically in the stocks of FUTU and TIGR, because I do see new users increasing like massively with the Chinese stock rally. Take a look at TIGR's Q1 earning, for example. Total revenue of 81 million, year-over-year increase of 225%, so more than triple. Net profit increased 21 times year-over-year, 2,000% increase. So the profit of Q1 has already passed the whole year of 2020. In terms of new users, so far they have had 1.4 million in total by the end of Q1, increase of around 300,000 in Q1, more than 3 times increase year-over-year. And 1 year after the company officially launched the internationalization strategy, the overseas customers accounted for more than 50% of the new customers in the first quarter. So in Q1, more than half of the new users are not from China. That is a very good sign for me. So I think this big increase of the Q1 earning is mainly because the US stock market had a very good run up in the first quarter. A lot of new investors joined the party and opened the account, and especially for many IPO, because people usually open more brokers account for pre-IPO purchase. Now you might think that if the Chinese government is cracking down the IPO for a lot of the Chinese companies, does that mean they would have less users? That is one of the risks, of course, but at the same time, if they don't get IPO in US, doesn't mean they don't get IPO at all. They might get listed in China, mainland, or Hong Kong. Let's compare to Robinhood's new users and their valuation. So the last updated number by the year of 2021, Robinhood users had updated to be 18 million. In terms of valuation, it says 20 billion, but I think it's more than that because the company plans to get IPO sometime this year, but the way for us to know their valuation close to IPO value would be the last time their share offer, and it was valued at 40 billion. And let's look at FUTU. By the Q1 earning, number of registered users worldwide reached 14 million, increase of 70% year-over-year. Revenue 280 million, so around 55% of Robinhood's revenue, same period. So it seems like in terms of the numbers of users, the revenue and the market cap, both companies, FUTU and TIGR, both have a lot of upside, a lot more room to grow. Maybe more for TIGR because it's smaller cap, it's newer, and TIGR is bigger market cap, safer investment, earlier into the field, more stabilized, and TIGR is more volatile. Both of these companies had a big growth rate in the year of 2020 and 2021 because of the bull market after the COVID crash, just like Robinhood. But at the same time, their growth were very limited because they haven't got the license for the Shanghai market yet. So new users can buy stocks in Hong Kong and US stocks. But the problem is a lot of the Chinese citizens cannot invest in foreign exchange yet, at least not until they pass that law. So the rapid growth they had in the past were very restricted. But until if any one of them can get the license to trade mainland stocks, then expect them to be explosive. They don't have a lot of users right now because their target audience can only be restricted to Hong Kong citizens and also some Chinese citizens that has overseas bank account and happen to have transfer money out of the country to the foreign account. So it's quite limited. And yet they are both making profit, and that is amazing already. FUTU's PE ratio is 64 and TIGR's PE is 80. No one really expects an internet company at early stage to make profit, not at the first few years at least. So that would be a surprise for investors to see them turning positive profit. And if they get the license of the A shares, I would think the real growth is yet to come. The higher probability would be first to FUTU, most likely because it's more established. For me, I think FUTU has a much better interface than most brokers in China. Better indicator and also easier to trade, very user-friendly. So if they get the license in mainland, I think a lot of the Chinese people would switch to FUTU instead of the ones they're using currently. Now, you may think that it's impossible to compare FUTU and TIGR with Robinhood because there are many more people investing in US stocks than Chinese. And of course, no doubt about that. But at the same time, in every country, there is an app to invest in US stocks, but not many ways to invest in Chinese stocks not listed in the US stock exchange. So there is a high probability that there would be only a few Chinese apps to buy Chinese stocks listed in China. So the question is really, can FUTU and TIGR get the license of the A shares anytime soon? And at the same time, there is competition as well, which is Weibo. I think a lot of people have heard of Weibo because a lot of YouTubers promote that, but unfortunately it's not listed. And it's more like a direct competition with Robinhood. So at this point, it would be a little bit speculating whether they can get the license and whether the Chinese government would approve Chinese citizens to invest in foreign stock exchange. So these would be the catalysts for the Chinese brokers. And very importantly, more unicorns, companies, IPOs, like for example TikTok. This would be the catalyst to drive more people register their account to participate. If TikTok really get to IPO in Hong Kong, I think a lot of investors from the world would be interested into investing in TikTok. That is just one example. So driving more traffic and volume into the Chinese mainland or Hong Kong stock exchange, it's like opening an Apple store in a shopping center can somehow increase the volume, the traffic. Companies like TikTok's IPO would for sure be like a flagship store. And the risk behind this would be, first, it's kind of cyclical. The share price movement might follow more on the stock index behavior more than the others because the index would have bear cycle and bull cycle. When it's bull cycle, it can perform better than others. When it's bear cycle, it can fall more than the others as well. Whenever there is bad signal, the market turns south, it might be the first one to respond and drop harder than the rest. And two is what I addressed before, that if the Chinese government is cracking down, banning the company's IPO, it would reduce the motivation to open new account. And number three is the valuation, because they had a great run up in the year of 2020. The share price had been priced in for high growth, so they have to maintain the high growth rate in order to keep the high valuation. So these are the risks you need to keep in mind. Now let's move on to the chart. While FUTU and TIGR are in the same sector, their share price are moving quite similar as well. So I'll just use TIGR as an example. First time I recommended TIGR was on this day. The day before the big run-up started, it was $17. I recommended it because it's an indicator for a bull market for the Chinese stocks. But I did mention that the run-up was huge in 2020, so it's completely normal to have a big pullback, a big correction. It did somehow from the high of 38 to the lower of 12, of around 13 in March, but did not continue to make lower lows. But the share price had gone up faster than I expected, breaking out of this triangle like forming a bull flag. So running from that time, it was 17 to the high of near 30 in a matter of 2 or 3 weeks. So then after the run up, every time my Discord members asked me when to buy TIGR, I would just say wait. On June 15, I was asked whether it's good to enter TIGR, and I said I don't think so because it would take at least 2 weeks to either consolidate or fall to lower support. At that time, it was around 25. And a few days ago, I said I think TIGR might either take some time to consolidate or fall back to the next support of 18. So price-wise, 21, you can start to open position, but be prepared to dip lower. And as we see on Tuesday, later on, it fell back to the lowest of 18.8. So it did reach the support of 18. And it seems like it got supported for now. So 18 should be a very strong support because it is the opening price of this day when it had reached the biggest volume of TIGR ever since the IPO. See, the gap was from 17 to 18. So the share price cannot fall below 17 to 18. If it does, it means there are institutions selling out. Then it would not be a good sign. So in the short to medium term, it cannot fall below 17 to 18. So if it gets closer to the support of 18, of course, it's much safer to buy in, and you can always set a stop loss slightly below, because if it breaks that support, chances are it will fall to lower range, more than likely. And for FUTU, it's around 129 to 30 would be the strongest support. And on Thursday, we see that it had reached the lowest of 133. Tested the support, seems like it's valid. So in terms of risk-reward ratio, I think it's pretty okay. Set a stop loss below the support. So in case it dips lower, you can buy back at the low price. Or wait for some stability first. Because right now with the environment, the atmosphere around Chinese stocks, it's not so great. So you are taking a risk here. FUTU and TIGR are similar, sharing similar price movement. Fundamental-wise, FUTU has a much bigger market cap than TIGR with lower PS ratio, slightly lower PE ratio for now. It is backed by Tencent, heavily invested by it because it is created by the founder that was one of the first of the Tencent team many years ago. So it seems safer and more stable than TIGR. But at the same time, bigger market cap means it requires more capital to drive up the price. So that would be your choice according to your personal preference or risk tolerance. Now that's it for today. Sorry for the long video. Let me know what you think about my bull thesis and the potential opportunity. If we are seeing the rally later on, instead of worrying about which stocks or sectors can benefit the most and sectors rotating between this and that, maybe broker stocks can benefit from all rotations between the sectors as long as the bull market sustains. Now, if you have enjoyed this video, please give me a big like and write me a great comment. And I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.